Welcome back. You're watching Stock Watch with me, Zinati Goma, and joining me to unpack your stock-related questions tonight are Graeme Körner from Körner Perspective and Roy Mutooni from Sanlam Investments. Be sure to send your questions via email to stockwatch@bdtv.co.za or via SMS to 41392 or on X using the hashtag StockWatch. Thank you so much for your time, gents. Has the election panic really just been a cloud of nothing, looking at how the rand is doing at this point? Graeme, starting with you.
Well, I suppose in a way we were pricing in kind of a doomsday, coalition from hell scenario. I think remembering that our market has been horrible for 5 years. So if you look at the incredible rally in many world markets, with most world markets almost in record territory, we were running the race with a lame leg. So I think against that backdrop, the fact that the South African equity market was weak, let's say in March and early April, created you have to say it was discounting a fairly anxious outlook for the elections. But it looks as though, from what we've seen in the some of the polls and some of the guidance in the more recent past, that we're not going to see a scenario where, in all likelihood, the ANC comes in under 40% and has to put together, as I say, a coalition from hell, which would most importantly, cause policy that has been established and possibly some of the reforms that are in process, to be stopped. So if you look over the last month, I think the South African equity market, the top 40 is up 9.5%. Obviously, some world markets similarly, but yes, I think we were just too anxious a month ago.
And really, it seems like we've bucked the trend of sell in May and go away. Roy, what have you made of this kind of trading against the norm for the month of May?
Well, this is a different time. Remember, I think from the South African perspective, we always start incredibly pessimistic about everything and eventually warm up and things start looking more palatable closer to the event. That's what tends to happen. And then after the event, we just muddle along.
Yeah.
That's been a tried and proven formula. But globally, I think the interesting thing has been this will he, won't he interest rate cut story has just made every meeting particularly relevant. And the watching over the inflation print and the really strong US economy has just meant there's not been the opportunity to almost dial down the energy and go into, I guess, the summer period that the Northern Hemisphere has. So I think that's where there is. And also remember, geopolitics has been a huge thing for this whole year. There's elections, there's a Middle East crisis. There's so many things that are going on that I don't think any market watcher wants to even get away from the screen for a minute. So maybe this year it isn't sell in May. Maybe this year it's just keep all hands on deck.
Yeah, indeed. And I guess a counter that has also benefited from the kind of positive trading that we have seen in the equity markets is Coronation. It actually came out with numbers today. Graeme, what did you make of that? And actually just even the company now declaring a dividend after last year choosing not to.
Yeah, well, last year you can basically say the SARS judgment wiped out the entire year's profits.
Yeah.
So now, arguably, with that provided for, obviously there might be interest, and we'll see how the thing goes, because that's obviously going to the Concord. But yeah, I think now we've got a view on how this thing is really trading, and I think we've spoken in the last while about the fact that because South African equity markets have done so poorly, and you've seen some of the bigger guys like Coronation obviously lose AUM. The share price got absolutely hammered. And at $30, $31, it just felt like there was so much optionality in that share, because I think the point is when things normalize, you lose assets, you gain assets, but remember, markets sometimes are friendly. They've got offshore assets as well. So I think, we were looking at, we have a small position in Coronation in our unit trust, for example, because it just felt like at $30, the bad news really was priced in. And I would argue that there's probably still upside in some of these asset managers and geared market plays. So I think the results are good. I thought they were maybe a little bit more optimistic or generous with the divvy than I would have expected, but they obviously have visibility. And the nice thing about asset management businesses, you've got reasonably high levels of visibility of income, unless markets really misbehave and you lose massive mandates. So, I think it's kind of back to business as usual. And now the question is, where's the next 10 or 15% in the markets? Because if markets are going to continue to rally, then companies like Coronation and 91 and other asset managers are going to print money. So then I would argue, as I said, there's probably more upside.
Well, actually, and that's the thing, because I was going to ask, because last year when the share price was under pressure, a lot of people were actually picking Coronation, saying that it's still a good business. It's just this blip that happened in their trajectory last year. Graeme says there's still more upside. Would you say the same, that the people that didn't go into it last year, Roy, that there's still some money to be made there?
Look, I think one thing which Graeme says that is absolutely correct is that it's a market-geared business. So if markets do well, asset managers tend to do well. But it's a South African asset manager, and there's some structural issues that they're facing up. And all of us, Graeme's business and our business as well, is facing up to the same things. The savings pool is not growing. We see outflows pretty regularly. You've seen the shift to offshore assets. So what I think you have in a normal time for these guys is a challenge to top line. So you don't have much top line growth. They did very well managing their costs. I think they said the operating costs were up about 5%, which is below inflation. So I would say you probably don't have much growth here in the absence of a significant improvement in market sentiment and in market activity. But that 10% dividend yield is nothing to be sneezed at.
All right, I hear you on that. Talking about sneezing, BHP came out and sneezed on the resources complex, Anglo-American. And of course, we have a deadline tomorrow. There is a question here, the merits of a long or short on BHP. Graeme.
Well, I can't really think why you would short it, because I think, water's still got to flow. Anglo's itself is in the process of cleaning its house up, so to speak. So arguably, if BHP was successful, which I think is quite a big ask, because there's quite a lot of planets that need to line up. Arguably they'll be getting a pretty decent business with some real trophy assets there. But at its core, BHP is just it's kind of the people like myself who are not mad about cyclical companies and tend to run underweight resources positions more often than not. BHP is probably the most predictable counter. If you look at what's happening in some commodity prices, I can't see why you would want to short BHP. So to short it on the back of, corporate action, and you're going to go long Anglos and short BHP, if they walk away or this deal doesn't happen, I don't want to be short BHP. So on those grounds, I would definitely not look at a short. I think it's as I say, it's a really good business. I would say at these sort of levels, it's probably more of a buy than a sell, but my sense is that commodity prices, particularly things like copper, have really run a little ahead of themselves, and on balance of arguments, I'd probably just wait a little while to get into the commodity cluster. But sometimes you see these things and idiots like me sort of say, well, I don't have to play there. I can actually just watch this thing from the sidelines. So you don't always have to play the corporate action game, particularly when there are lots of moving parts, as I think there is in this Anglo's transactions.
Yeah, indeed, a lot of moving parts, because we've been having viewers asking, similar questions for Anglo as well, if they should take some profits. Roy, in terms of BHP, how would you be playing it, and would you be letting corporate action form part of your decision making here?
So if you look at it from a pure fundamental perspective, great management team, solid in terms of execution, they rarely ever overpay, and they're very considered in their acquisition targets that you've seen them executing on in the past. So that's the fundamental. Now there's this deal. Whichever way it goes, it's a complex deal. It will take years to implement, absolutely. If they win, you may have the winner's curse there, that they're tied in all of this regulatory approvals and everything for the next couple of years, and unbundlings and everything. That's a distraction for any management team. So you have to be confident that over and above all of that distraction, there's significant value on top. But as Graeme has said, commodity prices have rallied. That copper price, that copper asset that they're looking for, the copper price has really gone up. So, so exactly like Graeme says, sometimes you don't need to be there. Is the honest truth. So sometimes you're better off sitting on the sidelines and watching the chips fall where they are. The guys who play merger arb and stuff like that, those guys will play the trade, and they may win or lose. But I think for the regular investor, maybe sit this one out, watch and see where it settles in, because there's a lot of execution risk. And one extra point is that if it doesn't happen, and BHP now has to look for another game in town, the Anglo's still in play, because they're going through their own restructuring. Maybe these guys come back. So yeah, I would say prices have moved. The world has changed. Maybe this is one just to sit on the sidelines and watch.
All right. I will give each of you gents a question on ETFs. Roy, I want to start off with you. Copper ETF, and Graeme, I'm going to give you a question on bond ETFs. So what is your view on a copper ETF, Roy?
Yeah, thanks for that one, Zinati. The thing about ETFs and commodity ETFs specifically, they'll behave very differently from investing in the company. Remember, when you invest in the company, you're investing in the upside in the commodity, plus operating costs and operating leverage, and all of those things that perform in a specific, in normal companies. So when you go for the pure ETF, what you're looking for is the performance of the commodity. So copper has a very strong narrative behind it, in the just transition, in greater industrialization, and all the amount of copper that's needed to transition the world into this low carbon world. So theoretically, it's not a bad investment to make. The thing to be clear about is, has the price rallied beyond where you think is fair value? Clearly, like anything, what you're betting on is the ability of miners to find new resources and make the investment to dig them out of the ground, which has been lacking, and that's probably why you have this BHP and Anglo story coming through. So I think, long story short, copper is an interesting commodity. The price has really moved. You have to be really confident that over time, scarcity trumps these elevated prices, and you get upside from there. That I think is where the investor needs to be thinking about before investing in a copper ETF.
Really interesting, because I mean, yeah, you're right. Going for a miner, also you stand the risk of, these operational challenges. For example, we saw with Goldfields, I think 2 weeks ago, when they released a trading statement, an operational update, saying that their share price was under pressure because of the some operating challenges. They're not really benefiting from the higher gold price there. So quite interesting take on that. Graeme, bond ETFs, listed offshore bond ETFs from the likes of Vanguard and BlackRock. What is your view there?
Well, not so long ago, we bought US Treasury ETFs for the first time pretty much ever, because, as Roy will testify, for the the longest time, interest rates made absolutely no sense, and buying US Treasuries at those ridiculously low rates because of the very loose monetary policies and quantitative easing and yield curve management really made you feel like you were taking your life into your own hands buying what's supposedly a low risk asset. But if I'll just talk maybe about the US, because I think there my sense is that yields look quite attractive. If you look both sort of around the 10-year and on the slightly longer term, you're looking sort of 5% or slightly below. So the advantage of that versus, say, a very short duration corporate bond fund is you're able to lock those yields in. And arguably, if bond yields do come off from 5, let's just call it for simplicity, to 4, you'll make a little bit of capital appreciation. So I think we think that we have concerns about the long-term outlook for US debt because they print money like there's no tomorrow. But I think that shoe's going to take quite a long time to fall. So if you're looking tactically over the next year or 18 months, we think there's quite a nice yield pickup in US Treasuries, and ETFs are the easy way to play that. I think the one thing I will say, though, we're talking now if somebody's actually got money offshore, you need to always just be mindful of CITES tax, the death duty tax. So we would generally look to rather buy Irish domiciled funds, for example. So maybe rather look for something that's domiciled outside of the US. But we think there's a little bit of money to be made and yields probably to be secured, and sooner or later, either because of banana peels on the floor or because inflation starts to ease, I think the yield curve will ratchet down a bit, and you probably at least locking in yield and have some optionality for capital gain.
All right. Well, thank you so much for explaining that to us. Let's get on to more questions. Discovery has fallen into a messy heap. Would this be time to buy? Roy?
So Discovery is an interesting one from the perspective that if you look at it from a pure operating company perspective, they've always been the champion of innovation, entering new markets and doing things differently, whether it's in banking or insurance or vitality and everything. I think the problem that you have with Discovery right now is they've invested a lot into this bank, and the bank needs to grow and become significant and start lending money broadly for it to start making money. And at the same time, you've got NHI, which I guess in the most extreme form will do away with administrators and medical aid schemes. And again, I say this is probably within the extreme form of the scheme when it eventually gets promulgated. So there's many unknowns here. The stock is as cheap as it's been in a very long time. And when you look at a business such as that, your downside risk is probably limited. They're not putting that much capital into that bank. I think all of the bad news of NHI is probably baked in. And like I said, they're masters of innovation. So maybe this is a point at which you should start looking at it. It's very difficult to read into the medium term, what the prospects are or what even the business will look like. But if there's anyone to bet on, it's what Adrian Goh and his team are able to deliver, because that's one thing they've been able to do, deliver during very difficult circumstances.
Graeme, would you be betting on Discovery or NHI?
Okay, so I'll start my answer with the fact that we were card-carrying members of the Discovery fan club a few years ago. It was a big position in our client portfolios. And I think if you go back 2 years, it was probably the single biggest position in our fund. But I believe there are operational problems. I think Roy touched on the bank. If you look at Insure, for example, it's also not really doing much. Obviously, they've had a few climate disasters and a few other things, but my sense is that I think, when was kind of the reason we were at the punch bowl was we believe that innovation and that shared value methodology would really propel the earnings at bank, at insurer, and it's not happening. I think also the problem is that in many ways I think the leadership are ahead of the organization. I think from a delivery point of view, a client experience point of view, it's really not great. So, we fortunately cut our position at good levels. We got lucky with the first 50%, and then we cut the residue by 50%, so I think about 145. In fact, we are completely in our fund. So we left with very small positions in client portfolios. And I don't think I would be buying it. I think there is some, as Roy says, there's some recovery potential. But I think Caesar is dead. Long live Caesar. They're going to also experience some competition from the innovation front. Because, you just see this explosion in AI. It's got to have an effect there as well. So, yeah, unfortunately, we've fallen out of love with Discovery.
All right. Well, another counter that seems to not have gotten a lot of love is Southern Sun. There's a question here on Southern Sun, well, rather a comment. So the viewer holds Southern Sun, it's 9% of their portfolio, and they're asking for a view on 5 years. The comment, eventually the good performance will show in the share price. Roy, is that something that you've noticed, that the performance is not really filtering through to the share price or not?
Well, no, it actually has. I'm just looking at one of the charts, and the share price has actually done relatively well. It's a bit illiquid, that's for sure, but that shouldn't be a deterrent.
Or unless the viewer wants more.
Yes, I mean, they benefited from the resurgence in tourism, people going back to casinos, and right now when there's no load shedding, it must be easier for people to go into these casinos. You must definitely question how well they'll do if interest rates don't come down and if people don't stop feeling all the pressure that they're feeling right now. But by and large, I think post-COVID, they've done really well. They've done really well, and they've progressed from where they were. So I wouldn't be questioning that business right now. Maybe it may have become a little bit extended or a little bit expensive, but I think they're playing in the right places. The pressure on them is very similar to any consumer-facing company that we have in SA, but they've executed relatively well and ridden the wave around tourism pretty well over the last couple of years.
All right. Well, we do have to go to your stock picks. Graeme, I'm coming to you with your stock pick. What are you choosing today?
I'm going to go with a very small company. I think a lot of people know the products, but they're probably not aware of the company. It's called New World Holdings. They manufacture, import, distribute in South Africa, in Australia, in parts of South America, in the Middle East. Small appliances like kettles and irons and ovens and microwaves and so forth. If you look at this business, it's trading probably at about 50% of NAV, and that NAV is pretty solid. In fact, it's trading just slightly above cash. Very, very tightly held by the family. This thing really does trade by appointment. But I think I would urge you not to rush out and take the first offer you see tomorrow morning, because the liquidity is poor. But we think that it's the ideal target, or an ideal target for a delisting, trading at about cash with a good business. And in fact, if you look, their international operations in the 23 year generated more profit than SA, and obviously SA is exposed to the consumer and inflation. But what you've got is a pretty decent business and good international operations trading a little bit ahead of cash. This thing to us just looks really cheap, but you've got to be patient. I think it might take a year or three to unravel.
All right. Roy, what are you picking today?
My pick today is Altron. I know IT companies haven't had the best of reputations, but this is a business that's gone through its own share of restructurings and problems, but it looks like it's beginning to come out of that. I mean, in the recent result, you could see they've fixed a lot of their baseline, and when you look at the actual companies they have, this is a strong potential one. It's a high growth platform in IT services group. They declared a dividend and they're moving forward quite well with regards to their restructuring. So I think it's one well worth watching. I saw management's been buying some of the shares recently. So yeah, this is one even I think I'll do a little bit more work on.
All right. Well, thank you so much for your time and for your insights today, gents. Really appreciate it. That is all for tonight's Stock Watch. Thanks to our guests, Graeme Körner from Körner Perspective and Roy Mutooni from Sanlam Investments. Up next, The Close. Stay tuned.